I could put out data on safe valuation caps all day, but why does that matter? Well, it matters is because behind that is frustrated founders looking around and saying, why are all my friends getting crazy valuations and nobody cares about me? Well, the story behind that is you're not a legible founder. You didn't come from the right schools, you don't have the right network, you didn't build a company before. And so venture is incredibly unfair. So from the first number, which is a safe valuation cap, to the actual thing, which is venture is unfair, is a lot of storytelling. And so you got to connect that number to the thing that matters.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing from the emerging manager perspective. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm especially excited to chat with Peter Walker of Carta. Peter probably knows the data of startups and venture capital like nobody else, so let's dive right into this. Peter, thank you for joining us.
Thanks, Tim. Welcome to our studio.
This is a fantastic studio. Been here before, love it, and really grateful you're taking the time to chat.
Absolutely, man.
Can you talk about your journey to Carta and then also as your current role of head of insights at Carta?
Yeah, head of insights is a weird little role. I don't know if it exists in a ton of startups, although I hope that it sort of broadens the aspect here pretty soon. The goal is to say, Carta sits on top of this data foundation that has so many startups and investors and LPs represented in it. How can we aggregate and anonymize that data and then give it back to the ecosystem so that they can get value out of valuations, fundraising trends, differences by industry, basically all these questions around venture that people typically have. We think that we're in a position to help answer them. So it's kind of incumbent upon us to do it if we can figure out how to do it in a reasonable way. And so I came to Carta 4 years ago to start this practice and was lucky enough that Henry and the team thought it would be useful. Maybe it was 2021, so it was easier to get hired then. I'm not sure I would make it through the doors at Carta now, but it's been an awesome 4 years.
And can you share what were you doing before Carta?
Yeah, so Carta is the biggest place I've ever worked. Like my background is all in early stage startups. So started a company in college and then right out of school joined this company as employee number 8 or 9. Data analytics, marketing, sort of mixing and matching. You know, it's an early stage startup. You're kind of doing 100 things. And then I found myself really lucky. I sort of had a moonlight second job during the pandemic at the Atlantic magazine. So I was helping run their data viz for the COVID project that they had set up. So that was a PhD in data visualization at scale, how to make interesting stories compelling in a moment where people were really, really interested in data and kind of nervous about what it was saying. So that was a really good experience.
Fascinating. I make broad assumptions, but I feel like maybe your lineage is 538, Atlantic, Carta, and the whole like datafication of news.
I love being included in the same timeline as 538. I don't know if I get to put myself up with Nate at all in that way, but yeah, something like that, right? Where it's, you have the core of the analysis is the graphic, and then you build the stories out of the graphics. I think that's definitely along the same timeline.
In terms of graphics, what are some recent studies or graphics you've done that you feel like has really changed the view of either start founders or VCs?
Oh boy. The stuff that we're always asked for from founders is a lot about how venture capital works in terms of dilution. So there's this like ongoing narrative, probably actually more expansive now, where you've got founders wondering, hey, is the dilution that comes along with the full venture capital journey worth it, right? Like, this is a ton of my company in this new AI world. Maybe I can take one round and done, or really manage the way that I have investors on the cap table a little bit differently. So those are fascinating. Dilution by round, all that kind of stuff. On the investor side, this is a slightly spicier one that we've put out recently, which is around bridge rounds. There's a part of me that thinks that a lot of venture investors do far too many bridge rounds. And there's a lot of human reasons why you might do them. And some of those reasons are very good. But I think in general, if you look at the data, if you're just taking a very cold analytical perspective, the number of bridge rounds in the ecosystem is far too high. And we can talk about what that looks like. But
let's double click on that right now.
Yeah.
Because so often as VCs, you're asked, are you going to do your follow on? Are you going to do your pro rata?
Yep.
And implicit in that, in some ways, is are you going to do the bridge rounds?
Yes.
And context, our firm stance is we don't do any of that.
Interesting.
And so and other VCs have said that's good and bad. The good is that like founders won't come to talk to you to be like, hey, like it's kind of like they're selling you, but they're pitching you, and do they want a real conversation or do they want your money?
Totally.
But you have some strong thoughts on this.
I just think that, so I'm interested in the idea that you say upfront, look, this isn't us. In some ways, as the other VCs have probably said, that makes your life easier because there's no expectation then that you're going to fund those bridge rounds. I think that a lot of VCs get caught in this period where they're investing, they're making new bets, the market changes underneath those founders, and a lot of those initial investments didn't get as far as they'd hoped. And so then you've got, I mean, we talk to VCs who half of their portfolio comes back and asks for a bridge. You can't bridge everybody, so you have to have hard conversations there anyways. And then two, I think that sometimes you overrate the signal that's been generated in that interim, call it whatever, 18 months, right? So like which companies to bridge, I think VCs often get that wrong. And then you're kind of throwing quote unquote good money after bad. You have more data on a Bayesian, like predicted or probability expectation. You have more data, and that data is not positive. Therefore, you should be more skeptical about those companies that need bridges, maybe even the new investments that you don't have as much data for, which sounds awful, right? Because you have these personal relationships with these founders. But I think on just a math basis, it really doesn't always make sense.
So many thoughts on this. First is so much of venture capital is behavioral economics.
Yes.
And within behavioral economics, there's a notion of endowment effect. And that is what you have and what you possess, you value more than others do. And I feel like that tends to result in follow-ons or bridge rounds. The other one is a statement made by Mike Maples around how him and Floodgate think about follow-ons. And that is they will not do a follow-on unless a major Series A investor does the follow-on. And so they won't trust their own instincts. They'll say, is this being marketed correctly? However, I talked to a ton of my pre-seed peers, and they said that is never a good indicator. Like through their own experience, like maybe they're bashing the bigger firms, but like they really don't know or can't tell what's good and what's not.
I think that probably both of those parties are right. The reason why I maybe tend towards the Mike Maples point of view is at least you're using an outside point of view there, and you're not predicating all of your judgments based on, as you mentioned, an endowment effect or a sunk cost fallacy where you're like, I'm already in this company for $1 million or $1.5 million. What's another $250K? Well, you add 2 or 3 of those up, and that's a new bet, right? And then that gets back to the portfolio theory of venture, which is probably on a median expectation basis, most pre-seed and seed funds are not investing into enough portfolio companies. They're like, there's the debate about concentration versus, a broad-based spray and pray, which I absolutely hate. Spray and pray is like one of the worst words in venture because it makes what I think is actually good portfolio theory feel bad. More seed investors should do more investments in new bets and less follow-ons.
Let's talk about this subject even more.
Okay.
So, Peter, you're a pre-seed investor.
Yep.
How many companies, investments, portfolios, startups should you be investing in? Would you invest in?
If I were a pre-seed investor, I'd shoot for 50 to 60, which is probably double what most people shoot for. And the reason being is, one, I would be epistemologically humble about my ability to pick winners. So I'm gonna get almost all of this wrong, right? So give me more shots at bat. The second is when it comes to follow-on or reserves, especially at pre-seed and seed, I think there are cultural dynamics that make it very difficult for you to even follow on to the quote-unquote best companies. So one of your context ventures, you invest what, 200 to 500K check, maybe?
A bit more.
500 to $1 million?
Yeah.
Okay, awesome. So you put 500K into this company as a pre-seed. Like, they're coming up on their Series A. Are you going to be able to invest pro rata, maintain your allocate? You're going to get pushed out by the bigger fund, like almost always, right? So if you just assume that at the beginning, you don't need to reserve as much, even for your best winners. You just write it as much as you can. And then we get to the other part of it, which is, as context, do you have a responsibility to your LPs and an advantage over bigger funds where you can just take some of that money out during even the A or the B, right? Like earlier secondaries in that way, where you're like, look, I'm either selling the pro rata or selling whatever to bigger funds. I think that's a very aligned model that probably does better on a median basis than the concentrate into winners. Because do you really know who's going to win? Okay, cool. One of your portfolio companies went from pre-seed to seed.
No.
Does that like you're still kind of guessing, right? You still don't know who the ultimate winners are going to be. So I think it's just there's a myth of this investor who can always see the future there.
So what I love about Carta is the data that you all produce.
Yeah.
And I'm looking at Q4 2024 state of private markets.
Yep.
And this is the printout I have, but I'm sure there's Q1, Q2 of 2025, or Q1's already been released.
Q1 is out. Yes.
So much of this data is data that me as a fund manager and other fund managers and founders are putting in.
Yep.
And that you neatly and very elegantly repackage.
Yep.
The stuff that we're talking about, like, hey, ideal fund size, ideal follow-ons, is never in this because it's the state of private markets as opposed to our view on the private markets.
Yep.
Would you all consider adding a section on, like, here's what we think is like
Commentary.
our commentary or our viewpoint?
I feel like I do some of that on LinkedIn, but you're right. Maybe we should make that a kind of a separate thing. There are landmine conversations in there that you could get in trouble with, but that's fine. As like someone who's been around venture long enough now, I think it's good to have a point of view on some of these things. But then, of course, we're going to be wrong about some of that, or I personally am going to be wrong about some of that. So, yeah, maybe we can be a little spicier, add some commentary sections.
Well, how about leveraging Tactyc, right? My
Yes.
understanding is Tactyc is going to help fund managers with all these questions around follow-ons, number of investments.
100%. I should have brought them up earlier. Tactyc, which is new to the Carta family as of 6 months ago, seven months ago, something like that. Anubhav and his team. Amazing product that goes through all this portfolio theory and allows you to forecast different scenarios. I think it's actually underutilized, even amongst the people who have Tactyc, how in-depth your scenario modeling can get. Just like, okay, a follow-on in this company versus that company, a reserve ratio change of a point or two, a difference in entry check size, a difference in entry check ownership. All of that stuff matters. And in a moment, let's be honest, where emerging manager fundraising is very difficult, more difficult than it's been in a decade, maybe. Having that buttoned up when you come to an LP and being able to walk them through different versions of the world, I think can really illustrate just how deeply you've thought about it as an emerging manager. So yeah, plug for Tactyc, absolutely.
As an emerging manager, I feel Carta is indispensable. And I feel like Carta and new technology has enabled the solo GP. Because in the past, like 10 years for sure, you could not be a solo GP because of all the requirements associated with fund admin, audit, tax, and so on and so forth.
What do you think the advantage of being a solo GP is? Or how do you pitch it to LPs when they ask?
So there's a lot of thoughts on this. First is I saw a LinkedIn post this past weekend where like Chamath wrote about how being a solo was like just made him move faster and was so much better. And previously, the past few weeks to months, I've been thinking about the trade-offs of being a solo GP. I can't be two places at once. I'm interviewing you. I'm not meeting another founder. And so there's trade-offs there. But I think this speed and simplicity of decision-making definitely goes to the solo GP. But you asked me a different question. You asked, how do I pitch it? And as I pitch it to LPs, I less pitch it and tell them a story. And that is when I went to go raise, I tried to find, for the first fund, I tried to find other VCs, but no one wanted to take those risks. They all had 7-figure salaries and they're just like, I don't need to take that risk. I don't want to take that risk. And now when I talk to them, I'm actually like, I don't want you on the team anymore. I've de-risked this enough.
The power dynamic has changed.
It has.
It does feel as though solo GPs are having a moment, solo and also spin out, and just kind of like small shops moving quickly. You know, the speed of decision making I think is a great one. There's also like it's not just that you would make decisions faster, it's that you can update your view of the world at a greater clip, which I think in today's venture investing environment is basically everything. Like the idea of being stuck in a committee mode when AI is changing everything about the companies you invest in, like that's really tough to get around.
And so much of venture also is following the wider, I guess, industry. And we talked about this a few weeks ago, creators. Creators are doing everything these days. And some of the best solo GPs are somewhat pseudo creators?
Oh, I think almost all of them understand the power of brand, and then they just kind of go about building that in different ways, for sure. But like, yeah, you and I have had many conversations about the value of personality in a world like today. It's everything.
Can you share more about a day in the life of what you do?
Sure. It's not that exciting. There's, I guess, in recent months, it's gotten a little bit more fun. So when I first came into Carta, it was literally just like be behind this desk, live in Tableau, like understand all of the various cul-de-sacs of Carta data that we have, of which there are quite a many. And now it's a lot of, and then from there we produce standard reports, we produce the constant social content, we produce uh, decks. One of the best parts about Insights is we get to fuel other teams at Carta. So a biz dev team might go and pitch new VC funds in New York. Well, they might use a deck that we created that has like state of private markets, but then tweak it so there's some New York graphs or something there. Like we can build such great fodder for every other team at Carta to use. So my time is often spent like thinking through those kinds of canonical decks that we're going to tweak. And then it's speaking. Like it's so interesting how at first I was kind of shouting into the void at LinkedIn and nobody cared. And then as the audience grows, it's kind of shocking how many different things you get invited to do. And there's just something of once you tip over to speaking in a certain place, then people look at who's spoken in those places before and they go, okay, well, he must be credible because he had this one invite. And that just kind of snowballs. And so now it's, I don't know, 50% of my time is spent talking about the data instead of just producing it.
I feel Carta is one of the best, if not the best companies when it comes to content marketing.
Yes.
Are there any other companies that you think rival Carta?
Well, they don't have Hunter, our amazing podcast and video producer. They don't have Josh, one of the creative directors here at Carta, or our social team's amazing. Like, and we get these topics. Like, I think that Carta is uniquely placed in some like content marketing, not only because we have data, but because one, the topics themselves are meaty. Like, it's kind of tough to explain what an ASC A20 valuation is, and so like all of that content like deserves to be rigorously produced and consistently updated. And so that's amazing work from our team. We have policy. So not only do we have a data insights team, but we have a policy team that actually tries to guide the conversation in Washington. That's amazing. So yeah, I think we're definitely at the forefront. Other content teams that I really respect, I think Stripe does an amazing job with their work. And then, you know, this is maybe talking my own book, but there's like a group of us on a WhatsApp thread these days that are building insights teams at B2B companies. And so I know probably a dozen folks or so who are like trying to start insights at their own companies. And that's so fun to see. That's cool.
I think Stripe is good. Where they might have Carta beat is Stripe Publishing.
Dude, unbelievable. They basically have like a Random House internally where they just publish amazing books. Like I read like basically everything they publish. They're one on bubbles and how bubbles are a good thing. Like amazing. Yeah, Stripe Press is really, really cool.
One time I briefly spoke with Patrick Carlson
Yeah.
and mentioned how Stripe Publishing might outlive Stripe, and it
Yeah.
might be like the Michelin Guide.
Yep.
Because like one of the books is on Charlie Munger's ideas. Like that's classic.
What did he think about that?
He didn't necessarily like that point of view, but
He did love
he
it.
appreciated the fan favorite, the standing of Stripe
I
Publishing.
mean, just get some people who deeply care about the stuff you're doing. That's the whole game, right?
And I was joking with you before we start recording that if you all publish these quarterly
Yeah.
and like sent me physical products, I'd subscribe to this.
Well, look,
'Cause
those
you got-
like booklets and like coffee table-esque things, like we should do maybe more of that. As a data viz nerd from way back, like, you know, the Edward Tufte books on data viz and like The World is Beautiful are my coffee table books and have been for a long time. So yes, I feel pretty lucky that we get to actually like build cool physical things, physical charts.
One of the things I've briefly also spoken with Henry about is around content marketing. You guys are unsurpassed. Stripe has an annual conference sessions. I feel like if you all did one, it's just like everyone would come because you are so embedded in the ecosystem, more so than payments.
Stay tuned. Stay
Okay,
tuned on
wow.
that.
All right, I'm excited. One of the things that I believe you do particularly well is not just show the data, but do some data storytelling.
Yep.
Can you talk about how you go about doing that?
Yeah, I think data storytelling, this actually relates very intimately to the founder life, right? If you think about a pitch, some part of that pitch is going to be about numbers. And numbers in a vacuum give you nothing. So it is incumbent upon you as the person doing the pitching to explain what those numbers mean in context. And through those numbers, explain something about the world. And so like when I'm thinking about what data storytelling means at Carta, it's just placing these numbers in the proper context and then putting that context into a story about the world. And it's that second part that is sometimes hard, right? Like I could put out data on safe valuation caps all day, but why does that matter? Well, it matters is because behind that is frustrated founders looking around and saying, why are all my friends getting crazy valuations and nobody cares about me? Well, the story behind that is you're not a legible founder. You didn't come from the right schools. You don't have the right network. You didn't build a company before. And so venture is incredibly unfair. So from the first number, which is a safe valuation cap, to the actual thing, which is venture is unfair, is a lot of storytelling. And so you got to connect that number to the thing that matters.
Do you ever time content so that it's coming out in concurrent with something else? Because like you have so much fascinating data around safe stacking or the diversity of venture capital or founders.
Totally.
How do you think about when you release content?
Yeah, it's the goal is to be always on, but then have spike periods where maybe we're going to release content in advance of a product release at Carta. The other kind of half of that is there a way so that you can make your content involved in some way with the current conversation? Some of that is very, very micro, like, oh, we want there was a story in the information about Miami. What data do we have on Miami? That sometimes works, not all the time, candidly. It's like hard to newsjack that way. It's more that when we see conversations, for instance, the conversation around venture that I think has been happening over the last 6 months more than it ever has is around secondaries. What is happening with secondary liquidity? So we have data on that. We've been working with the reporters and stuff to get that out there, but there's sort of longer gestating conversational moments that I think brands would do well to be a part of, because you're not trying to put the focus on yourself. You're either supporting or contradicting arguments that are kind of already out in the world. And that's an easier way to get your stuff in front of a lot of people.
Well, Carta to me is a place of record.
Yep.
Or as Henry has shared before, like an ERP.
Yep.
But it's also a content machine. And with Tactyc, it feels like it's going to be a little bit of a predictive machine. Some of the things that I would love as a emerging manager, and sometimes we co-create companies, is can you give us data on you should go fundraise now? You should, or you should actually slow down your pace.
Yep.
Do you think that's going to be happening in the future?
Yeah. What behind that is the opinion question, right? So like, how much opinion do we want to put into
Carta
products?
AI?
100%. There's definitely conversations around it. We want to be careful that we're not oversteering people, because it's venture. One of the things about venture, which is consistently humbling to me at least, is I spend all day looking at this data and I'm just wrong about a lot of stuff. So we've kind of put all these words and jargon and process to an inherently incredibly messy thing that is starting a company. And so it doesn't always work that way. But insofar as we can help, particularly emerging VCs, make better decisions based on, tips or tricks or, predictions, I think it's definitely something we're thinking. Yeah.
That question, really the root of it is the evolution of Carta. So you all started as cap table product, then fund manager product.
Yep.
Now it's not just emerging managers, but private equity.
Sure.
Can you talk more about that evolution, whether it's on the product side or on the content side?
Yeah, the product side has been fascinating to watch. I mean, when I joined Carta in 21, we had a fund admin product that we were starting to see really, pick up, but it had only been around for a year, 2 years max. And then from there, there's all of these, as Henry likes to say, like the private operating system, or for the operating system for private capital, it just doesn't exist right now. And we are uniquely positioned to build it based on the trust that we've earned from founders on the cap table side and then on to investors, et cetera. Like certainly you were thinking about the limited partner node of the whole ecosystem, and just there's 1,000 things to build there. I think one of the coolest parts about funds, which is nerdy, but everything that matters to a fund, except for maybe categorizing expenses, it happens outside of the fund, right? Your portfolio companies build and fundraise and die and get bought and whatever, and the fund is reflective of those underlying events. So the amazing part about if we build this correctly is that tying those two things together means you don't have to go searching for events that matter to your accounting. They just exist in your general ledger upfront. And there's so many advantages for having that be the case. So we think we're on the path for that sort of products tie-in. On the content side, that just means that I get to spend a lot more time thinking about what GPs are thinking about instead of just founders. And that has candidly made my founder content better too. Because you're looking at it from both sides. I know it's really hard for founders to sit there and go, why should I care what the VC is thinking about every day? But it does matter if you want to raise venture capital.
It does, because it takes two people to dance.
And the GPs, I mean, you can speak to this better than I do. They are not without pressure themselves. They have their own investors to answer to. They have their own worries about the world and what's happening within their fundraises, which are as hard oftentimes as the founders' fundraises. So a little bit of empathy up and down the stack, I think, is useful.
Earlier, you had mentioned you spend a lot of time in Tableau.
Yes.
You also do a lot of time. I've seen your podcast. It's great.
Yeah.
I'm a subscriber.
Thank you.
And you interview a lot of emerging managers, which is also fantastic. Yep. And then you also create a ton of content. How much time do you spend on Tableau, Looker, or some BI tool these days versus being the face?
Don't know about being the face, but certainly I talk a lot. I think that I still try to spend, I would hope, at least 25 to 30% of my time building data products and data viz and all that kind of stuff. The reason why I think I can talk confidently about venture is because I built those things, right? So like, it is an advantage when I get on stage and somebody asks me a question. It's like, well, I've spent weeks looking at this data. So even if it's not in the visual, I can talk to it in the behind the scenes. That makes you a better speaker. So, and I think that today's moment of AI enabled workflows, et cetera, makes everyone who wants to be a public person, I think, should be a subject matter expert first and foremost. You can't, like, if I just did talking, I'd be worse. I'd just be worse at it than if I have a combination job like that. And I should mention, I have an amazing team now that helps with a ton of the work products. So this is not I could not do all this just as a solo GP, for instance.
One of the great reports you all do is your annual equity report.
Yeah.
So this is 2021, but you all do this every year.
Yep.
And I believe that it helps bring transparency and fairness to the market.
Yeah.
How have you seen that over the years? And I feel like there's been some shifts, George Floyd, now where we're at. But I still feel like this report is important.
We agree. It's a pretty sobering report to put together when you look at how much venture capital is going to women founders, how much is going to underrepresented minority founders, all that kind of stuff. And when we first started putting it out, there was this sort of general trend of slightly better every year, not great, but slightly better. There was at least forward movement. And then sadly, this most recent report, we actually saw some of those metrics decline again. And what we think, this is a little bit of a guesswork on my part, but I think a lot of what happened over the last year and a half is the VC demand and desire for repeat founders just went through the roof. And who are repeat founders most likely to be? White dudes, because that's who founded companies 8 years ago. So I do think that this tendency towards, in a more risky environment, higher interest rates, whatever, you look for ways to de-risk early stage investment. And the easiest way to de-risk is to say, have you built something before? And that, by definition, is a little less equitable in many cases. So, we can talk about prejudice and all that kind of stuff. I think that's a lot of what's happening, but it's a sobering study to put together.
So this is equity. It doesn't really touch on venture capital, but you had mentioned a bit earlier around the bifurcation of venture and how increasingly it's the platform or the franchise funds that are ingesting all the new capital.
Sure.
What do you think is happening in venture, and then how do you think this will play out?
I don't think it's happening. I mean, it has happened. There has been a split between the mega funds and everyone else. The real question for me is what happens to the middle. I think everyone kind of agrees mega funds will do the mega fund thing. They'll take option calls at early stages and then they'll follow on. And to them, and I think, people always kind of complain a lot about, oh my gosh, how could LPs devote capital to these businesses? It's like, I actually don't think the LPs are making a terrible decision. It's very difficult to invest 100 million into 100 or 10 emerging managers when you have, one person in Andreessen to do. So that's one side, and I think that's a totally viable business model. The other is super early small funds taking those risk-adjusted bets on early stage founders. Context, many other people doing that. Those two things I think are pretty set and great ways to make money. The question for me is what happens to the middle of venture? What happens to the $300 to $500 million funds?
And there's a lot of those.
Tons of those, way more than you expect, right? They're going to lead Series A's. They're going to kind of lead maybe a B here and again, or like follow on to B's and C's. And so there's two pressures on them. One, the mega fund side. Two, from the bottoms up view, how much capital are these founders really going to need in this AI world? Are you going to need $50 million rounds? Sure, if you're an open AI, you need all the capital that you can eat. But for most companies, is that going to be the case? I think it's a really tricky moment. So venture is too wide of a word, but it's the best word we have right now to describe all this stuff. I'm excited for our language to probably update in the next couple of years where we start talking about early stage venture as something completely separate from late stage growth venture.
Do you think Carta would ever produce like a state of venture, like just like annually, like a big book around just all things that we're talking about?
I want to. We need. I think we need a few more $10 billion funds on the platform where we can talk really seriously about what's happening on the mega fund side. But everything else we got. So I would, maybe we need to fully produce a coffee table book. Sorry, Nicole, if that idea doesn't get through marketing committees.
Well, one more question around content.
Yeah.
And our conversations make me think about, there was this dating book that came out like 10 years ago. And it was from one of the co-founders of like this dating app. And it was just so fascinating around like how there were extremes around how if someone was attractive or unattractive, it still drove like a ton of kind of demand. And I feel like Carta one of these days could like create something just as fascinating, like data that you would have never thought about was happening in the startup ecosystem.
Hopefully not dating data. I don't think
Totally.
I think that's our first one. Yeah, the stuff that, so look, our data is so dense and amazing. And then there's also so many qualitative factors that are not in the data set that people always ask us about. So are you a first time or repeat founder? Demographic data, although we can get some of that occasionally, but much more around like, where'd you go to school? What was your life experience? Where do you bring product and technical knowledge into this space? Or are you a complete newbie? How did that stuff work? I would love to do some more qualitative sort of survey or, adjacent data and then marry it up with the equity tables because there's so many other questions to be answered. I feel like our data is super robust and also just the jumping off point for a lot of other questions.
Speaking of data, I want to do a quick plug for Carta to listeners, and that is we use you all for fund admin.
Yep.
We've used you all since we started in 2021. This past long weekend, as I was catching up on work, I was sending over, these are investments we've done. Carta, please add it to my schedule of investments. I can't imagine as a solo LP, GP, handling all the fund admin work. And so was very pleased that you all launched your tax product.
Yep.
So now we not just do fund admin, we can do tax.
Yep.
I'm very keen. Maybe one of these days you'll launch your audit so I can just be like, click this easy button and just be done with it all. Because boy, oh boy, is it not easy.
Sure.
And it does take time. And just love how simple, straightforward, cost-effective Carta is, and highly recommend that to all my fellow emerging managers.
Thanks, man. That means a lot. I mean, shout out to the delivery teams on our fund admin side there. They're unbelievable. And they get way more into the weeds than I, at the surface level ever get to play in. But it's been cool to watch. And tax is so, like you said, so many of these are sort of compliance things where it feels like I did the work. We made decisions throughout the year, and now we have to spend so much time basically reporting those decisions to various people. Like our goal is to eliminate those processes when we can.
It helps a lot. I want to keep my LPs happy for obvious reasons.
For sure, yeah.
And if I can deliver K1s in a efficient, expedient manner, then I want to do so.
We want to make you look good, right? And those LPs, that's all part of the brand for the LPs.
In terms of Carta's evolution with emerging managers and private equity and the whole ERP notion.
Yep.
Where do you see that going?
I think, look, we spoke about it a little bit. I think that there's distinctions between parts of private capital like real estate and private equity and private credit and all these things. And at the end of the day, you're running a fund, and there's a ton of nuance and variability. But we think that if we can produce core workflows that automate portions of this fund for venture capitalists like yourselves, there's no reason why we wouldn't be able to help and maybe even improve the lives of some private equity investors down the line, et cetera. So really cool work from the product team coming out on that over the next, I mean, I think it's going to be the work of a couple years at least, but it's exciting to watch. And then it's on us to make sure that the product is as good for founders as it is for investors, as it is hopefully for LPs down the line.
We're bouncing around, but I want to go back to this topic of safes and safe stacking.
Yeah.
And so curious what kind of reaction you got to that post around safe stacking, because I think they're very, very dangerous. And then the second one is, what other juicy content can you kind of foreshadow or share that you all will be sharing soon?
The safe is, it's funny, the safe feels to some people like this newfangled thing, but it's really almost a decade old now, maybe even close more than a decade old. And I think it's getting a little long in the tooth. I think some investors realize it's being used in weird ways that were not the actual first best use of this instrument. So if you're doing one round, that's amazing. Use a safe. It makes a ton of sense. But if you raise at 2 or 3 or 4, as that graphic showed, there are some companies who raised at 10 or 11 or 30 different valuation caps. Like that is a mess. That's a complete mess. You as the founder don't know what you own, probably. 2, and this is probably the harder part for a lot of founders to not realize, every increase in that valuation cap resets the expectations for the price round. If you're an investor and you were investing into the pre-seed, you're not super happy if 2 years later that company converts at the cap. That wasn't the point. That was 2 years, right? So it raises expectations down the line for both the investors in the price round and the earlier safe investors. And I just think people are overusing them because it's easy. And you don't have to bring lawyers as much into it. But there's a reason why lawyers can sometimes be good. Convert.
I feel that type of data could be good in future Carta reports, which is not just the safe stacking, but this is how much we saw when you did a safe versus a price round in terms of legal fees. Because I feel like founders, everyone can be myopic and say, oh, I just want to save now, but here in the long run, here's the consequences. But even just showing like the comparison.
I think that it's actually underrated, like you just mentioned, how much of the legal fees for a lot of these rounds are driven by the safe conversions, right? And making sure that if you've got 3 or 4 different val caps or pre and post money or mixing or whatever is actually driving that legal bill of the seed or the Series A up. Definitely happening. We're also, just the way that safes are this instrument where, the allure of them is based on their simplicity and like anyone can understand the safe doc pretty well. I do think that there's going to be a move towards standardizing priced round funding on the NVCA docs even more than it is now. Hopefully that starts to reduce the price. We have a product called Deal Closings where we help founders do the admin work, but we're never going to replace lawyers. You need a good lawyer, but some of these price rounds are very, very expensive.
Totally.
Especially here in Silicon Valley, like it can get pretty wild.
Yes.
Yeah.
I'm curious, you just alluded to this. Would you all ever collaborate or just create your own? Here's actually a priced round document as opposed to a safe.
We're definitely collaborating with a bunch of different law firms on that, with Deal Closings and other places. I think there's going to be movement in that space. I think there was actually a discussion recently on Twitter about who should pay the legal fees, founders or investors. Standard is that founders pay for their investors' legal fees. I could make an argument that that's not okay, for sure. But it is the default around venture right now.
It is the default. Having done price rounds, I will say that most smart founders will cap the legal fees.
100%.
And so then the shift goes back to the VCs.
For sure.
I feel like that's probably a good middle ground.
I agree. And I understand why. Look, the VCs are like, well, actually, I'm paying these still because the round that we're raising from my capital. So it's a little bit of like taking money from different pots, but it all kind of ends up in the same place. But it is another one of those things that, first-time founders who are thinking about venture get into, and they go, oh, are you kidding me? I have to pay my investors' legal fees too? Like, what don't I have to do?
True, but I might be biased here. You might be missing the mountain from the molehill. There are other things you should negotiate first, like board observer, board control, pro rata, follow-ons, valuation before that term.
No doubt. No doubt.
Can you foreshadow some juicy content that you all are cranking on?
I would say two things that are upcoming. So first, we've released great data these days on fund benchmarking for fund performance, TVPI, et cetera, the stuff that LPs typically ask for. We're going to do the exact same thing, but for fund expenses. So how things relate to the management company, the expense ratios, the management fees, the carry, the everything. So hopefully that's out before the end of the year, which I think will be really cool. And by fund sizes, so you can see how it changes as your fund matures. The other thing that we're always asked for, and please don't hold me to this for 2025, but all the founders like, Peter, this data is great. Thanks so much for the valuation stuff. What's missing is financials. What's missing is how much ARR did a Series A company have, and how did that influence the valuation? Wonderful question. We're working on it. Hopefully by the end of this year, we're going to have a data set that's robust enough to start reporting that out too. And then you can really get to the heart of what's $1 of ARR worth, which is, I guess, one of the bigger questions around venture right now.
Both data sets are going to be very much welcome.
I'm excited about it. Yeah.
The one around venture capital that I really enjoyed that you all produced a few months ago was around deployment rates.
Yeah.
And just how fast or how slow certain funds were deploying.
Totally.
And what was really eye-catching was that post-2021, funds were very conservative on the deployment of capital.
For sure.
And
to the frustration of many founders, I would assume.
Totally.
Yes.
And then on the second data set that you all will be releasing, I am really curious what that revenue multiple on AI companies are.
It's the question around venture right now is, well, there's two questions. One, what is an AI company? What counts? And then two, how fast are they growing really? Right? Because we read the cursors and we read, the Databricks, et cetera, or a couple of these startups that are getting to 10 or 100 million ARR faster than anyone ever has before. How widespread is that? What are the actual multiples on it? What percentage of companies within various stages would qualify as those fast growers? Like, all that stuff is super fascinating.
We're running out of time, so I'm going to go through some rapid fire questions that we typically do to end these podcasts. Who are some of your favorite content creators that are VCs? Now, I'm not asking you to judge them on the quality of their investments, purely on their content creation, which can be very different.
100%. Yeah, that we can divorce this from the fund perspective for sure. Charles Hudson, first and foremost, read everything that he publishes on Substack. Couple other ones. Nicole Wishoff is great. I think that you have to count the Technology Brothers podcast as if you are not involved in some way, just at least with the clips on TVPN, you really don't know what's happening around venture. And it's so interesting to watch a new show capture that much attention. There are tons of content creators around venture who are like, damn, I wish I had thought of that, because it's such a good platform for them. So,
it kind of came out of nowhere.
Crazy. Literally built CNBC overnight for people who care about tech. That's awesome. And remains to be seen how long lived it is. Will we be having these same conversations in 5 years about it? But I think those guys are so smart. They'll pivot the model. They'll figure out a way to stay relevant. And that's the currency right now.
I think I would add Sarah Guo to that.
Oh, love her. Yeah, for sure. Conviction is really cool.
And then what's fascinating is venture creators like Eric Torenberg getting acquired by a platform.
Big respect to Eric, right? Yeah, that's I was a doubter, I think, at the beginning, but Turpentine totally proved me wrong. It's an amazing network of people. And it's also interesting to watch people who used to do other things now get into content, or they realize that content is this distribution arm that you kind of have to have. So it's a crowded space, but a lot of good stuff being produced.
What's more important, content creation or distribution?
Distribution for sure. The problem is that you can survive for a long time on great distribution with not that great content. It's kind of difficult to get great distribution if you don't have great content, which hopefully means that the newer stuff is better. But look, if you just filter Substack to venture capital and see the 250th to 1000th newsletter, you're not reading those, right? It's really, really hard to stand out. So, the last person I want to shout out is Namdi. How do I pronounce his last name? Irregulum, maybe? He's a Lightspeed guy, and he produces really great content, data-driven content on just how many startups should we be expecting to work?
Hmm.
Like, what is the latent availability of startups in the world and stuff like that? Really cool, dude.
We'll definitely check that out. We talked about VCs. How about founders? Founders to follow.
Founders are great. I think
Peter, for sure.
not a founder, but or at least not anymore. So definitely, if you have a moment, would love a follow.
And Henry Ward.
Number one for sure, absolutely. Actually, has been producing content from way back in the day. I think kind of dominated Medium for a long time before that ran out of gas. What other founders? I think that at Typefast. So Ryan at why am I blanking on his company? The shipping company. Flexport. Yeah. An incredible example of someone for whom you're not coming to Ryan for all sorts of VC takes. You're coming when like the world is in crisis. Like when a ship gets caught in the Suez Canal, you go to Ryan's Twitter. That's an amazing place to be where you are the subject matter expert for a thing that your company does. Like, I don't think anybody has done it better than him in terms of being so deeply associated with a problem or a space. So that's for sure one. There's a lot of other ones that I could name. The interesting thing about founder content is I think a lot of it, at least on LinkedIn these days, is kind of the same. And it feels very formulaic.
Humble brag.
Yeah, humble brags are like, this is how my last sales call went, or like, this is when you should hire your first salesperson. And some of that is great, but I just want it to be infused with a little bit more personality. Like, just because you're telling a personal story doesn't make it personable. Like, put yourself into that. Maybe I'm just reading too many AI comments or whatever, but it feels a little bit staid lately.
How about LPs?
There's not a ton of LPs who do a lot of content. I mean, Sapphire and Beezer is, like, I think the key one there. Stepstone Group does some cool and interesting stuff. Screen Door as an LP group does some cool and interesting stuff. But I think the content space for LPs is actually kind of wide open. And there could be much more on the LP side that I would love to read.
Favorite books?
All time, Ender's Game, Taipan, which is a companion novel to Shogun.
James
Clavell. Absolutely love the whole Asian saga from James Clavell. And then, like, I'm a sci-fi nerd primarily, so like you have to read Foundation. Like Asimov's got 100 books that you should love. What other books? On venture, The Secrets of Sand Hill Road is out of date. You have to read it, I think, to have a decent understanding. And then I think the actual book about venture capital is not a book. It's the trajectory newsletter. Like, read Ben Thompson. That's the creator. Like, you barely even have to mention him. Like, you have to read Ben.
Favorite snack?
Beef jerky or gummy bears, which are terrible snacks.
Are they
not together? Not together. That would be weird.
Are they stress snacks or just snacks you just enjoy?
Both, which is a problem. Yeah. I've actually tried to make a rule that I'm not allowed to eat gummy bears in the city of San Francisco. It's not going great.
Favorite travel spots?
I just got back from Japan, one of my absolute favorite trips ever. So that's certainly on the list. And then I'll shout out, I'm going back for Startup Fest this year. I really love Montreal in the summer. I've never been in the winter, so maybe it's not the same. I'm guessing it's not the same. But in the summer, Montreal is really awesome.
Favorite movies?
Almost Famous. I don't know. A couple other favorite movies that I've seen. The Three Amigos, which is not a good movie, but it's a funny movie. And maybe my movie taste is not great, to be honest, now that I'm thinking about it.
Last question. Startups. Bullish, bearish for the next 5 years?
Absolutely bullish, with a tinge of bearishness for the employees. So I think this is one of the biggest things that keeps coming up is like founders are increasingly focused on that ARR per employee metric. They're trying to do more with less, which is obviously a good thing. But on the margin, that means that somebody like me who came out of school and wanted to join a startup as employee number 5, 6, 8, whatever, will have less of an opportunity to do that. And if I hadn't done that, I would have none of the skills I have. Because the amazing thing about joining an early stage startup is you just get thrown in and you look around the room and you go, well, if we don't do it, it's not going to get done. So I hope there's a lot of room for early like making room for the early hires, I think is still really important. And those people can go on to be great founders and the whole thing. So
You all have created great content around equity for early employees.
yes,
And consistently, the feedback has been that early employees are not compensated with as much equity as they probably should be getting.
they're certainly taking on a lot of risk adjusted to the equity reward. It's a pretty tough call. So that means if you're a founder, in some ways it's like, well, if this person is really focused only on the equity and nothing else, like are they the right person for this business? But also you can kind of take advantage of someone who's only doing it for the mission, right? And they're just like, I don't even care what you pay me. I just want to be involved in this company. That's a beautiful person to find. Don't undercompensate them just because you can.
Totally. That co-founder versus employee one equity like cliff is massive.
Huge. Which is why I think a lot of people would be like, yeah, I'll just go and found my own thing.
Totally.
Right? Yeah.
Peter, this has been fantastic. Thank you for creating the great content. Thank you and team and Henry for the great fund admin product and cap table products you all have. And really appreciate the recommendations you have around other founders, VCs, LPs to follow and keep creating great content.
I'll do it, man. Great to see you.
Thank you, sir.
Cheers.